You open Binance. You see Bitcoin at $65,000. And you think, if I buy now, I'll be rich in a month. You've seen the screenshots on Twitter. Someone turned $500 into $50,000 in 3 weeks. Another guy quit his job after one good trade. It looks so easy. So you buy. You watch the chart. Green candles. Your heart races. You're up 8%. You think, I'm actually good at this. Then it drops. You're down 12%. Panic. You sell. 2 days later, it's back up. You do it again. Different coin this time. Same result. After 6 months, you check your account. You started with $5,000. You now have $2,100. And you have no idea where it went. Here's the thing. 95% of all retail crypto traders lose money. Not because they're stupid, not because they don't try hard enough, but because the system is literally designed for you to lose. My name is your name, and I spend way too much time thinking about why people fail at crypto, even when they're doing everything they think is right. If you're someone who's lost money trading crypto and can't figure out why, hit that subscribe button and give this video a thumbs up if this helps you out. Because what happens to crypto traders isn't random. It's not bad luck. It's a pattern. A predictable, mathematical pattern. And if you don't understand it, you'll keep bleeding money until there's nothing left. The statistic nobody wants to talk about. Look, the story everyone tells is simple. Crypto trading is risky. Some people win, some people lose. That's just how it is. But that's not the full picture. Studies from multiple sources, including data from major exchanges like Binance, Coinbase, and independent research, show that somewhere between 90 to 97% of retail crypto traders lose money over time. Let me say that again. 95 out of 100 people who try to actively trade crypto end up with less money than they started with. Not break even. Not a little less. They lose. And most of them don't even realize it's happening until it's way too late. Now, you might be thinking, yeah, but that's because most people are idiots. I'm different. I do research. I watch YouTube. I read charts. Here's the problem. The people in that 95% thought the exact same thing. They weren't gambling. They weren't throwing money at random coins. They were trying. They were learning technical analysis. They were following experts. They were managing risk. And they still lost. So what's really going on? Why the system is built against you? Here's what most people don't realize. When you trade crypto on an exchange, you're not playing against the market. You're playing inside a system where the house takes a cut every single time you move. Let me show you the math. Trading fees. On Binance, the standard trading fee is 0.1% per trade. That means every time you buy, you pay 0.1%. Every time you sell, you pay 0.1%. Round trip, 0.2%. Doesn't sound like much, right? Now let's say you're an active trader. You make 10 trades a month. That's 10 buys and 10 sells. 20 transactions total. 20 by 0.1% equals 2% of your entire portfolio gone in fees alone. Every single month. Over a year, that's 24%. Before you even account for bad trades, timing mistakes, or market volatility, you've already lost a quarter of your money just to fees. But it gets worse. Because most people don't make 10 trades a month. When they're actively trading, they're making 30, 50, sometimes 100 trades a month. At 50 trades a month, you're paying 5% in fees. That's 60% per year. You need to be right more than 60% of the time just to break even. Not profit. Break even. And here's the kicker. Most traders are right less than 50% of the time. The psychology that kills you. Okay, so fees are brutal. But that's not even the biggest problem. The biggest problem is your brain. Because crypto doesn't move like stocks. It doesn't move like Forex. It moves fast, unpredictably, and with massive swings. And your brain is not built for this. Let me walk you through what happens to most people. Step 1. FOMO, fear of missing out. You see Bitcoin pumping. It's up 15% in 2 days. Twitter is going crazy. Everyone's saying this is it, the next leg up. You feel it in your chest. If you don't buy right now, you're going to miss out. So you buy. At $65,000. Step 2, euphoria. For the next few hours, it keeps going up. You're up 3%. You check your phone, every 5 minutes. You think, I knew it. I timed this perfectly. Step 3, the drop. Then it reverses. Hard. Down 5%. Down 8%. Down 12%. You're now at a loss. But you tell yourself, it's fine. This is just a dip. It'll bounce back. Step 4, panic. It doesn't bounce. It keeps dropping. You're down 18%. You can't sleep. You check the chart at 3 a.m. Finally, you can't take it anymore. You sell. At $53,000. Step 5, regret. 2 days later, Bitcoin is back at $64,000. If you had just held, you'd be fine. But you sold at the bottom. Because you panicked. And here's the brutal part. This is not a personality flaw. This is how human brains are wired. We feel losses more intensely than gains. We make emotional decisions under stress. We follow the crowd when we're uncertain. And the market, the whales, the institutions, the algorithms, they know this. They count on it. How whales and institutions exploit you. Now let's talk about who's on the other side of your trade. When you buy Bitcoin at $65,000, someone sold it to you. When you panic sell at $53,000, someone bought it from you. Who? Not other retail traders like you. Whales and institutions. These are people with millions, sometimes billions, in capital. They can move markets. They can create the exact conditions that trigger your fear and greed. Here's how it works. Phase 1, accumulation. The price is stable around $50,000. Retail traders are bored. Nobody's talking about it. During this time, whales are quietly buying massive amounts. Phase 2, pump. Once they've accumulated enough, they start pushing the price up. Not violently, just enough to create momentum. $52,000, $55,000, $58,000, $62,000. Now retail notices. FOMO kicks in. Everyone starts buying. The price spikes to $68,000. Phase 3, distribution. While everyone's euphoric and buying, whales are selling. Slowly, gradually, into your buy orders. Phase 4, dump. Once they've sold enough, they stop supporting the price. It crashes. $68,000, $60,000, $55,000, $50,000. Retail panics and sells at the bottom. Whales buy it back. Rinse and repeat. You're not trading against the market. You're trading against players who have more information, more capital, and better tools than you. And they win because you lose. The leverage trap. Now let's talk about the thing that destroys accounts faster than anything else. Leverage. Exchanges love when you use leverage. They push it hard. Trade with 10x leverage. Maximize your profits with 50x. Here's what they don't tell you. 75% of all leveraged positions get liquidated. Let me explain how this works. You have $1,000. You use 10x leverage to open a $10,000 position on Bitcoin. If Bitcoin goes up 10%, you make $1,000. Double your money. Sounds amazing, right? But here's the catch. If Bitcoin goes down 10%, you lose $1,000. Your entire account. Liquidated. And in crypto, 10% moves happen every single day. So even if you're right about the direction 60% of the time, one bad trade wipes you out completely. The exchange, by the way, doesn't lose. They take your liquidated funds as fees. Leverage isn't a tool to help you. It's a tool to extract money from your account faster. The winner's bias. Okay, so if 95% of people lose, why does everyone on Twitter seem to be winning? Simple. Winner's bias. People who make money post screenshots. People who lose money stay silent. For every guy posting, I turned $1,000 into $100,000. There are 95 people who turned $1,000 into $200 and said nothing. You don't see the trades they lost, the accounts they blew up before this one, the fact that they got lucky on one trade and will probably lose it all next month. You only see the highlight reel, and your brain thinks, if they can do it, so can I. But you're comparing your reality to someone else's best moment. That's not a strategy. That's a recipe for disaster. What you should do instead. So does this mean you can't make money in crypto? No. It means you can't make money trading crypto the way most people do. Here's what actually works. 1. Stop trading. Start investing. The people who make consistent money in crypto are not traders. They're long-term holders who buy during bear markets and sell during bull markets. Not buy today, sell tomorrow. Buy this year, sell in 3 years. 2. Dollar cost average, DCA. Instead of trying to time the market, buy a fixed amount every week or month. $50, $100, whatever you can afford. Over time, this averages out your entry price and removes emotion from the equation. 3. Only hold Bitcoin and Ethereum. 95% of altcoins go to zero. If you're not an expert, stick to the 2 assets with the longest track record and the most institutional adoption. 4. Never use leverage. Ever. If you can't make money without leverage, leverage won't save you. It'll just kill you faster. 5. Ignore crypto Twitter. Seriously, every guru is either selling you a course, pumping their bags, or lying about their returns. None of them are your friend. The hard truth. Here's the thing nobody wants to hear. If you're trying to day trade crypto to get rich quick, you're not investing. You're gambling. And the house always wins. But here's the good news. You don't have to gamble. You can play a different game. A game where time is on your side. Where you're not fighting whales. Where fees don't bleed you dry. That game is called patience. It's boring. It's not sexy. You can't brag about it on Twitter. But it works. So here's the decision. Do you want to feel like a trader? Or do you want to actually make money? Because you can't have both. If this video helped you understand why you've been losing money, hit that subscribe button. Drop a comment and tell me, how much have you lost trying to trade crypto? And be honest. Because you're not alone. See you in the next one.